Dear viewers, welcome to yet another edition of Expert Speaks. In this episode, we are going to answer the questions raised by some of the NRIs about property dealings of NRIs with one another NRIs. NRIs are fond of properties. Everybody is very happy to buy a property. But when it comes to question of selling property, that's where a lot of details, lots of problems come up. One NRI asked me the question, can an NRI sell the properties to another NRI? And he posed me a lots of questions. I thought we should be doing a detailed video on this subject to answer the queries that could be there in the minds of other NRIs as well. In this episode, we are going to talk about in detail how an NRI can sell property to another NRI, what are the care that you need to take, what are the points that you have to keep it in mind. This is NRI Money Clinic for you, and I am Dr. Chandrakant, your financial guide for a happy living.
NRI Money Clinic. No hype, just the right advice.
Dear viewers, to talk about the nitty-gritties and the taxation issues pertaining to the property dealing of NRIs when they sell it to another NRI, I have requested my eminent faculty, Chartered Accountant Sriram Rao, to be present for this program today. He needs no introduction, a practicing chartered accountant, a man with extraordinary experience in direct taxes, dealing with the NRIs, solving the complicated tax issues. You have seen him in multiple number of videos. Welcome to the show, Mr. Sriram Rao.
Thank you.
Mr. Sriram, one of the person asked me, an NRI, I am going to sell a property, but I want to sell it to another NRI. Is it the same dealing as like anybody else? Are there other things that has to go into consideration into this? I have listed several questions in this. Let's move one step at a time and try and answer these questions. My first question to you is, can an NRI sell property to another NRI? Is it yes or no? Or are there any exceptions to the rule? Or is there anything else that has to be kept in mind in this?
NRI can sell the properties to another NRI. Okay. Now, this sale or transfer of property from one person to another can happen in multiple ways. For example, that is pure purchase transaction. Okay. NRI can sell it to another NRI, any immovable properties other than agricultural land, farmhouse, and plantation property within India. Okay. That is purchase transaction. Second transaction comes as gift. So any property other than agricultural land, plantation property, or a farmhouse can be gifted by one NRI or OCI to another NRI or OCI. There is no restriction in this regard. Okay. But agricultural land, plantation property, and farmhouse cannot be transferred from one NRI to another NRI or a OCI. However, the third way of getting a property is by way of inheritance. So inheritance can be done in any manner and any property, including agricultural land, plantation property, or a farmhouse. Transfer of property from one NRI OCI to another NRI OCI is permissible under the law.
So there is no difference that way. It is an NRI can dispose of his property either by virtue of a direct sale and purchase by another NRI. He can gift or he can inherit from one NRI to another. Only exception being agriculture land or related properties along with it, like you said, farmhouses and other things.
Correct.
Mr. Sriram, the property transactions happen and people agree on the pricing for transfer of properties. Are there any guidelines over there? It's just the absolute discretion or willingness of two persons to exchange these properties at whatever consideration they wish to get it transferred? Are there any guidelines on that?
Any amount negotiated between the buyer and the seller would be the full value of consideration. However, any such negotiated value is, if it is less than the government value or guidance value or circle rate, as it may be called in that particular region, then that variation should not be more than 10%. Meaning thereby, the sale consideration should not be less than that guidance value or government rate by more than 10%. That means, for example, if the sale consideration is fixed for a property at rupees 10 lakhs, and if the guidance value is say 11 lakh rupees, that is 10% of that 10 lakhs, that is 1 lakh, add to that is 11 lakh. Then under that fact and circumstances, then there is no issue. If the government value is more than 11 lakh, then the government value would be taken as actual sale consideration for the purpose of both the buyer and the seller.
Okay. So it only means to say there are two NRIs. You can't decide on a price as you wish like. So there is a guidance value while you exchange properties between two NRIs. Under no circumstances it can vary from more than 10% of the guidance value. If it is more than the guidance value, that's perfectly fine. But if it is less than the guidance value, then you are liable to pay the applicable stamp duties.
Yes.
Is my interpretation correct?
Yes, and at the same time, for the purpose of taxation also, the guidance value would be considered as the sale value of consideration rather than the actual sale consideration which has been passed on by the buyer and seller.
Okay. Mr. Sriram, there are two NRIs. Now they have an opportunity to sell the property which is permitted by law. One of the questions that arises is, can they exchange these properties and by payment of consideration outside of India or in the form of cash? Is that possible for NRIs? Is it permitted?
No, both of that transactions are not permitted. Foreign Exchange Management Act clearly regulates this transaction. So it clearly states that all the transactions should be carried out through banking channels under these fact and circumstances, and the consideration should be deposited to the seller's NRO account, non-resident ordinary account in India. So the entire transaction should happen in India, as well as cash transactions cannot happen at all.
Okay. So point to remember NRIs here is that no cash transactions whatsoever forbidden. You cannot settle the sale proceeds outside of India. Point 3, it must be settled in the Indian bank account, that is NRO account. This is the position of law. Please do not deviate from that. Otherwise, you are going against the law. Mr. Sriram, while making the payment, NRI's case is a unique case. Both the buyer and sellers have got NRE and NRO account, in addition FCNR account as well. Now, which is the bank account which is preferable for the buyer and seller, or are there any restrictions? You did tell them about the restriction that the seller can receive payment only in his NRO account. That point you have told about the seller. Now, between these two accounts, how the monies can be transferred?
It is very clear. I have already told the seller can receive the funds only to his NRO account, and he can receive only to his NRO account. He cannot ask the buyer to make the payment to somebody else's NRO account or somebody else's resident account or whatever it may be, like power of attorney holder or relative as such. No, such payments cannot be made, and the payments has to be made to the seller's own NRO account. Okay, this is very clear. Then, from the point of view of the purchaser, he has an option to make the payment either from his NRO, NRE, or FCNR account. Now, if the payments are being done from his NRE or FCNR account, then such payments are considered as done on repatriation basis. If the payments are made from NRE or FCNR account, then such payments would be considered as done on repatriation basis. If the payments are made on repatriation basis, it is relatively easier for that buyer whenever he sells that property again to remit the funds outside of India, because there will be lesser restriction as such. Now, if the payments are made from NRO account, that will be considered as payments based on non-repatriable basis. So at that time, there might be some restrictions, okay, for remittance of funds outside of India. As on date, there is no such differentiation, and any investments made either on either on repatriation basis or non-repatriation basis can be remitted through $1 million scheme. But if the payments are, remittances are exceeding $1 million, then only if the earlier payments are done on repatriation basis, that is from NRE or FCNR, only then it will be allowed to be remitted outside of India with the prior approval of RBI. Done.
So the point to summary here is that an NR has an option to pay for the property from NRE, FCNR, NRO account. To the extent possible, the preferable route to make the payment is from NRE or FCNR, keeping in mind the probability of you repatriating this money outside of India in future, even though current laws does not prevent you repatriating money even from your NRO account. It is just a precaution. Wherever it is possible, it is better you pay it from NRO or FCNR account into seller's NRO account. Mr. Sriram, NRIs are governed by two laws, the income tax law and the FEMA law. Now, when these transactions happen between two NRIs, are there any other things that the buyer and seller have to keep in mind, or are there any compliance obligation issues that need to be looked into?
Now, let us look from the point of view of the purchaser now. Purchaser has obligation under Foreign Exchange Management Act as well as under Income Tax Act. Now, as far as Foreign Exchange Management Act, it is mandatory for both the purchaser and seller to exchange their KYC between one another, to say that I am an NRI or a OCI, and my OCI card or passport copy or even visa copy, etc., has to be exchanged between themselves. Someone may ask whether such exchanges are possible, whether they are ready to give that documentation. But in my view, it is quite easy to and easy as well as very much required compliance to be done, because under both FEMA and Income Tax Act, there are repercussions, and each other has to face the repercussions very quite badly if they do not disclose to each other their residential status. Okay, and it is similar to the documentation of the property. Like if the title deeds can be exchanged, copy of that can be given to the purchaser well before the sale of the property, to determine whether the title is properly held by the seller or not, so that it can be transferred by the seller to the buyer. So similar to that, this KYC documents has to be exchanged, and it has to be exchanged with each other. Both the buyer should know and the seller should know, and they should exchange the documents each other. So this is very important. Then second, from the point of view of the purchaser, it is obligatory under the income tax law that he deducts tax at source. Whatever may be the consideration, he should deduct tax at source at applicable rates. If the properties are long term, then 20% plus surcharge and cess. If the properties are short term, then 30% plus surcharge and cess. That much of TDS has to be deducted from sale consideration to be paid to the seller. So again, to deduct that TDS, the purchaser has to use the TAN, that is tax deductors account number. If he does not have a TAN, he has to obtain a TAN and make the TDS payment well before the date of transfer, and then accordingly file the TDS returns periodically as it is required to give the credit of the TDS to the seller's account. So this is obligation of the purchaser as such.
To summarize, it is essential that buyer and seller should exchange KYC. Some people may get confused with the word KYC. KYC stands for Know Your Customer, which means establishing your identity, establishing your tax code, and establishing your address and your residential status. That is what KYC stands for. Buyer has an obligation to find out who is the seller, and likewise vice versa. The buyer should ascertain whether he's buying from a resident individual or he's an NRI. And he should also look at the property document because he has to ascertain whether the NRI who is selling this property has acquired it in accordance with the applicable law of the land, or whether there is a violation at the time of purchase by the seller. Likewise, he should know whether it is a short-term capital gains tax or there is a long-term capital gains tax. The buyer has an obligation to deduct the TDS. But yes, the seller can work around that and he can apply for a lower TDS certificate from the income tax department. And if the seller provides these documents, and you can check from your chartered accountant and the lawyers at the time of sale whether the TDS can be bypassed based on the document issued by income tax department. Is that correct, Mr. Sriram Rao? That system is still there, right?
There are certain changes, small changes that has happened over the period of time, but not major. Now it is obligatory of the obligation of the purchaser is to deduct the TDS, and the rate of TDS has been given in the law. Now, when it comes to the seller, it is his obligation. If he wants the TDS to be deducted at a lesser rate, then he has to approach to his jurisdictional assessing officer, obtain a lower deduction certificate, and provide that lower deduction certificate to the purchaser, so that he deducts the TDS at a lower rate than what is provided in the law. It is really the obligation of the seller. That's it.
So, in the absence of lower TDS certificate issued by the income tax jurisdictional officer, the applicable tax rate has to be deducted and paid to the department by the buyer. That's a major obligation. Otherwise, it becomes a hanging sword on them over and above the consideration what they have already paid for the property. Mr. Sriram, you told about the TDS obligation on the part of the buyer. What is the tax liability and obligations on the seller?
Now, if the property is sold for more than 20, if it is held for more than 24 months and then sold, then such property would be considered as long-term properties. If it is held for less than 24 months, then it will be considered as short-term properties. Okay. Now, the tax rate for that would be different. For long-term properties, the tax rate would be 20% plus surcharge and cess on the capital gains earned. And for short-term capital gains, it will be slab rates, and generally if the income is exceeding and coming up to the higher level of that particular person, then generally the tax rate would be maximum 30%, or it can be lesser than that as all.
So in such case of capital gains, there is no surcharge effect will come.
Both surcharge and cess would be applicable. Say for example, if the income is exceeding 50 lakhs, then surcharge will be applicable at 10%. And cess anyway will be there at 4%. So
that's what I mean. This is the basic slabs are in accordance with the slab rate of the income tax in case of short-term capital gains tax.
Yes.
And in case of long-term capital gains tax, indexation benefit is also available.
Of course. See, the computation mechanism is similar to what is available for residents also.
Okay.
There's all the type of deductions available would be available. Indexation available means available. There is no change in that law at all.
Mr. Sriram, I have one last question for you. NRIs will settle outside. They may require funds outside of India. One NRI sells the property and he discharges his tax liability in the form of TDS or applicable taxes he has paid by obtaining certificate from the income tax department. The residual amount after he discharges his tax liability, can he repatriate this money outside, or is there any restrictions for repatriating this money?
Yes, absolutely. If the property has been acquired in consensus with the provisions of Foreign Exchange Management Act, then the entire consideration after payment of due taxes in India can be remitted outside of India. There is no doubt whatsoever. However, there are certain finer points to it. Say, for example, if the amount to be remitted is below $1 million per annum, then there is no requirement of prior approval of the RBA, and irrespective of the number of properties sold and type of properties sold, or whether the funds are repatriable or non-repatriable, or the investment rather, whether it was done on repatriable basis or non-repatriable basis, the entire amount up to rupees $1 million per financial year can be remitted outside of India. The only condition here is that the investment or the acquisition of the property earlier should have been done in consensus with Foreign Exchange Management Act, and the applicable taxes should have been paid. That's it. However, if the amount to be remitted is exceeding $1 million, at that time, there are certain conditions to be fulfilled with. For example, the investment should have been done earlier on repatriable basis, that is either from his NRO or FCNR account, and the prior approval of RBI should be obtained, as well as if the property which is being sold now is a residential property, then the consideration up to 2 residential properties can only be repatriated or remitted outside of India. So more than that, there would be restrictions, and the RBI may not allow such remittances.
Okay. So if it is a residential property, maximum 2 properties. That is at a time or lifetime limits?
There is no clear guidance on that. We have inquired with the RBI, and they have also not properly, provided any guidance. But we believe that it is lifetime, but only in those cases where the amount is exceeding $1 million, only then it will be applicable. Otherwise, if the amount is less than $1 million, then There is no restriction applicable. Any number of properties can be sold and the consideration of that can be remitted outside of India.
So which means for most of the NRIs, 99.9%, this is not something to be worried about. If it is a high value transactions and if it is complicated, then you refer to the concerned professionals or apply for RBI, get the clearances and get it transferred, or wait for yearly limits of $1 million and they can do the repatriation as per the law there. Mr. Sriram, now the money could be repatriated. We are in agreement with that now. Now the next question is, NRIs are spread across the globe and each country has its specific laws pertaining to inheritance, sale of property, taxation of global income and other things. When an NRI sells this properties in India and repatriates this money, will he be liable to tax in some other country? Is there anything in the DTAA agreements which can help him relieve the tax pain points in those countries?
See, whether the capital gains earned in India, whether it is taxable outside of India or not, that would depend based on the tax laws of that country. Even the computation of mechanism, how to compute the capital gains, that would be as per the law, domestic law of that country. Because generally, in all the double taxation avoidance agreement, in respect of immovable property transaction, the rights have been provided to those respective countries, both resident as well as the country where the consideration or the capital gain is earned. Both the countries have the right to tax that particular income. So that being the case, our resident country may opt to tax that income or not. That depends on the particular law of that particular country. Okay. Now, if that particular country opts to tax this income, at that time, the taxes what has been paid in India as a NRI, that can be claimed as a foreign tax credit against the taxes payable in that country, so as to avoid the double taxation of the same income. In India, if he has paid some X amount of taxes, that can be claimed against the taxes which is payable in the country of his residence. That is called as foreign tax credit, which is ultimately would avoid the double taxation of the same income in two different countries.
To summarize, is it fair to say that as a general rule under DTAA, both countries have a provision to tax the capital gains, but whether to implement it or not is the discretion of individual country or the prevailing tax laws there. See, for example, in case of US, they tax the global income, but for somebody who is living in Dubai, it will not be taxed in Dubai. So it is the prerogative of the country where you are residing to design that laws. But if such laws exist in your country, you stand to gain offsetting of taxes already paid in the country where you have done the sales. And you can claim an exemption as per the double tax avoidance agreement. Only condition being there should be a double tax avoidance agreement between these two countries. Luckily enough, most of the countries have got double tax avoidance agreement with India, yes, barring maybe a handful of few of them. That's a good news for the NRIs. Mr. Sriram, thank you very much for this comprehensive video on which you have dealt on each and every aspect of sale of properties by NRI to another NRI, taxation, banking account, repatriation, taxation in both the countries. I'm sure my audience have got their answers that they were looking for an answer there. So thank you very much for your time and your courtesy to come all the way and solve the issues for the benefit of NRI community. I remain in gratitude to you for your kindness. Thank you.
You're welcome.
Dear viewers, we have done multiple videos on property transactions by NRIs, either between NRI and NRI or NRI to resident, taxation, precautions, and several other things. There is a playlist on this channel which talks about property transactions by NRI. Also, some of the important videos like the sale consideration, computation of tax, we are giving a link here in the card section as well as in the description box below for your guidance. If you want more knowledge on the property transactions, please do check out on these videos and get yourself guided. Hope the video that I've done today helped you to understand the finer points pertaining to property transaction between two NRIs. If it did help you answer the doubts that could be there in your mind, please give me a thumbs up. Don't forget to share these videos with your near and dear ones and friends and relatives. Thank you very much for watching this episode on NRI Money Clinic. By the way, before I conclude, If you are a person who is yet to subscribe for the channel, please do hit that subscribe button now. Press the bell icon so that whenever we release the video, you will be notified. I shall be back with you next Tuesday with yet another expert, with yet another useful topic. Till then, stay safe. Jai Hind.
Press the bell icon for more details and subscribe our channel.